But let's first turn our attention to this breaking news coming in, and that's to curb the trading frenzy in the F&O markets. Now, market regulator SEBI has announced a slew of measures to strengthen index derivative framework to protect investors and improve market stability. Now, this also includes reducing expiries on a weekly basis. In fact, each exchange will now be allowed to provide derivatives contracts for only one of its benchmark index with a weekly expiry. SEBI has also increased the minimum trading amount for derivatives from 5 lakh to 15 lakh rupees, and these new norms for derivatives trading will now be rolled out in phases starting November 20th. And to give us more details about these norms, my colleague Ankur Mishra is joining us. Ankur, so SEBI has for long spoken about investor interest and investor protection amidst trading levels, the kind of levels that we've seen currently, particularly with respect to the F&O norms. Retailers have already been losing a lot of money, particularly young investors, but do these norms help and really tackle that challenge of investor protection?
Yes, SEBI has now finally rolled out the norms for future and options. And the important thing to note here is that all the 5 recommendations which were given by the committee, which was also there in the consultation paper, has been accepted with few modifications. Now, what were these recommendations and what has SEBI come out now? Upfront collection of margins, removal of spread benefit, which was there earlier, intraday monitoring of position limits, and also the most important thing, the contract size change, which has been now decided by SEBI that from earlier limit of rupees 5 to 10 lakhs, the minimum contract size should be 15 lakhs and it can be up to 20 lakhs. So 3 times increase has been there for contract size. Apart from that, one more decision which has come from SEBI now is the weekly options rationalization. Now, this will impact exchanges as well, because currently there are many of the series which are there in BSE as well as NSE. Now, both the exchanges needs to sit together to decide that weekly options contracts will be limited to 1 per exchange. To discuss this about, we have been joined by 2 important guests, Kunal Bothra as well as Nuresh Mirani. Welcome to ET Now, gentlemen. My first question to you, Kunal, will be, will it control the frenzy which is there in F&O? And more importantly, will there be an impact as far as the volumes are concerned?
Thank you so much, Ankur. I think first, 2 parts. One, of course, the trading volume would be impacted with it as an initial basis, because, for example, when you remove the benefit of calendar spread on the expiry day, when the volumes are increased for lot sizes, and when the weekly number of contracts, because right now we were looking at almost 4 to 5 weeks on every month where there used to be weekly contract, weekly expiry, that gets reduced to just 1. So now, on the basis of these effects, of course, the volumes would drop down. The second and the most important part is that, the features like options, the collection of premium on an upfront basis. So this would probably increase or rather reduce the leverage for traders who are, trading with more of a speculative mindset. So that intent, from the SEBI is very clear that they want to curb the speculative mindset. So that gets restricted to a larger extent. One a feature was that in the last, maybe 2-3 weeks of this market rally, a lot of the contracts were already above the normal size. So the normal size which was mentioned was around 5 lakhs per contract, but many of the stocks were trading as it is about 10 lakhs to 11 lakhs. So maybe adjustment of, the revised contracts to 15 lakhs may not be a big tweak to the investors or to traders, but I think, yes, the collection of options, premium, upfront, the calendar, benefit, that gets removed. All of that would probably curb the volatility to a larger extent.
Yes, Nuresh, I want to come to you to understand more first on this contract size. For the benefit of viewers, would you like to explain that how will it work? If suppose a Nifty contract was available for, let's say, 50,000 or 60,000, how much a retail investor will have to pay now so that that intent which SEBI has shown now will actually be implemented?
So, see, initially, we generally had 25, 50, 75 as the sizes for Nifty or 100. So, given that now the minimum requirement is 15 lakhs, it implies you have to have more than 60 as the contract size. So ideally, it will go to 75. That implies whatever were your sizes, it will increase by 3x. So if your margin was 50,000 rupees, now the margin requirement will be 1.5 lakh rupees. Same way, the earlier, say, contract size would imply 6.5 lakh as the total notional value. That will go closer to 18 to 19 lakhs. So it implies a 3x size change in terms of the contract size for Nifty at least.
Right. Kunal, how should one take and understand this upfront collection of option premium as you were explaining? Now, as far as the practicality is concerned, there is a transition time which has been given. But how did it work till now, and what will be the change now?
See, what used to happen earlier was that the collection of options premium was used to be done at the end of the days. For example, if you are taking positions say on Monday for an expiry which is on Wednesday or Thursday, depending on what index you're looking at for Bank Nifty or Nifty, then the options premium used to be collected at the end of the day. But now, before taking a position, you need to have that kind of an amount so that the particular options could be traded, whether it's on the buy side or whether it's on the sell side. So that collection of premium, which is to be delayed throughout by the end of the day or till the end of the day, that gets taken into an upfront basis, which means this would cut down leverage. Now, if, for example, if traders used to be buying positions, on the basis of leverage on the option side, that gets cut down because, we've seen the data also coming out from SEBI that the number of players who've been making losses in the markets, the majority of the losses comes into the F&O segment. And that generally happens when there is a speculative mindset. So, which means the collection of options premium on an upfront basis would probably reduce the leverage, and indirectly it would also indicate that there could be a reduction in terms of volatility as well.
Yes, definitely. From 89% in 2022, that data has gone to 93% in past 2 years as far as losses for F&O investors is concerned. But most importantly, Nuresh, market was already down for last 2 days. Was market already anticipating the same? And how do you see the impact when we open on Thursday?
I don't think there is an impact on the markets per se, because if you look at it, this is only on the index derivatives and derivatives, and there is good enough time given. We've also seen a 50% cash margin come in. We've also seen 1,700 stocks get out of the pledge and become 650, 670. That gets finally done by 1st November. We did not see any impact. Those were much bigger impact. Out here, what gets done is mainly the impact is on, say, the price impact could be on some brokers, broking companies, exchange companies, because those are the ones which get hit the most, because suddenly from every day being an expiry, you just have one in a week. Also, the volumes get lower, so it would be more a stock-specific impact and not an index impact. And also the fact this was very much needed because 94% of the traders were only trading options as per the data. Not just about losses. When you say only 94% were only trading options, implies the margins individuals were very low margin retail clients. So there was a need to increase the margin size so that the low retail margin guys do not come into play. But I do not think there is a major impact on the markets as such. But yes, some stocks would be impacted.
Yes, Kunal, as Nuresh was also explaining, these kind of final circular was already expected in market. In fact, first of all, there was a committee recommendation, then draft circular came, and now final circular has come. So market was already aware about it. It will not be any kind of knee-jerk reaction even on the stocks, which has been mentioned, especially the broking ones. And also, more importantly, how will the investors recalibrate their strategies to deal with this circular now?
Yeah, this is a very good question. Extending on what Nuresh said, this impact is would generally be felt with the retail investors and the ones which have very low ticket size. For the HNI traders and the institutional traders, this would not impact in the same proportion, a similar proportion. So that itself tells you that the market direction may not be guided by the small investors, and that's why it will not have a knee-jerk impact as such. Yes, it may be a sentimental impact, but we've seen that our markets are very matured, and I think in that sense, even if there is a mild bit of volatility which comes by, I think the markets would probably, be very, calm enough to absorb this volatility on an initial basis and then get into a settling mode. So I don't see any major impact coming into the markets on an immediate basis. The only best part about this, rather what we can expect, is that this curbs down the speculative mindset, of traders coming into the F&O. So, look at it this way. The premise of getting futures and options was to hedge your cash position. Over the last 2 decades and so, that mindset had changed. So from being a hedge strategy, it had become an excessive speculation kind of an instrument. So with the regulations and the rules being taken by the consultation paper, from the consultation paper, I think we are now looking at a complete domain shift of reducing the speculative mindset and trying to get back into a position or a play where you're looking at F&O or futures and options as more of a hedged kind of an instrument.
Right. Now, as far as the specifics are concerned, one of the impact is, of course, rationalization of weekly expiries. Right now, there are many options for the traders to do that every week. But if that will be rationalized, of course, the weekly contracts will be limited. How will it impact the exchanges part? Nuresh, I want to understand you. Although there is a glide path which has been given to each and every circular, how will you see that the exchanges will get impacted? Do you see that the volumes will get dropped?
So ideally, the volumes should get dropped. How much is something which a number would come up from a lot of companies and research when they do the exact numbers. But a majority of the growth which came in BSE and NSE over the last couple of years, a large part of it came from options. BSE was not very active in options, and now they've got into options. So they will be impacted. And the fact that there were 5 days where there would be expiries, now there will be just one in a week, that implies there has to be a reduction. How much as a quantum is tough to say as of now, because we did not, the volumes did not increase 5x in a jiffy when we went from 1 weekly expiry to 5. So anyways, Nifty and Bank Nifty have been the most traded ones. So there would be an impact. It's tough to call. The last we know is there was an article by one of the discount broking companies, Zerodha, wherein it said there could be a 30 to 50% drop, which is generally an exaggeration. But yes, there has to be some drop. It cannot be safe.
Right. Kunal, do you think it will be kind of a double whammy, considering the fact the charges which were announced in the budget that were effective from 1st of October? Now, this glide path is also given from November to February 1, 2025. All these norms will be implemented in phases. How do you see the recalibrated strategy? And I'm specifically mentioning this because we may see the F&O market change, and that change will be remembered later. What all announcements were made by SEBI earlier?
I think so, Ankur. What we have to remember is that just prior to the weekly expiry being formed or formulated for Indian markets, we were going through a phase where the monthly expiry was going on with full gusto. So in the monthly expiry, there is to be strategies which were being formed by traders as well as research analysts. But now with the advent of weekly expiry, the number of strategies, the frequency, the trading volume had increased significantly. So one part is that yes, the trading volumes would get impacted, but on the other side, because the trading volume would drop down, the volatility would also drop down. So volatility is always an instrument or a play with respect to how the trading volume or the speculative mindset goes. Now, if the speculative mindset drops down, the volatility has to get curbed down. So it may have a negative effect on an initial basis, but eventually, I believe, as I said, once the market settles into this, absorbs this kind of a change which comes by, I think it could probably be very good for the markets, and that speculative intent, I think that could get curbed or controlled to a larger extent.
Right. Two quick questions to both the gentlemen before we let you go. One being the fact it is a zero-sum game in market. Somebody makes money and somebody makes loss. But in this case, of course, so many of the discount brokers have said that they will suffer losses, they will have to shell out more money. But who will actually gain? First, Kunal, you?
I think I think it's a net. So futures may be a zero-sum game, but eventually, if the volatility drops down, it's eventually a win for the Indian markets as such and the Indian investors. So I don't see any major wins and many major losses. I think we have to look at both sides of the coin. And at the end of the day, if it curbs down the volatility, if it curbs down the speculation, if it curbs down the losses and the extent of losses which retail investors have been making over the last many years of the data been published by SEBI, I think it's going to be win-win for the Indian investors at large.
Right. Nuresh, same question to you. The data said that 1% of algo traders were making money, and they were some of them were based outside India. But now, do you think after these norms, that kind of balance may change?
So the balance generally doesn't change. The fact remains, in a speculative instrument, 80% of the people lose money, 20% make money. The Pareto principle remains the same. But in this case, a lot of people were participating in Indian markets. When you look at it, say 43% of the total, say traders who were trading in individuals on derivatives were below 30 age, right? So you had youngsters. The largest amount of growth came from states which were not generally the big participants before. You have almost 94% of the participants trading only options, right? So it tells you if we reduce the number of expiries, at least implies the volumes go down and there are lesser places for retail traders to lose money. So the balance may not change. There has been an increase in STT, etc. So there will not be a major change for STT as well. There could be a little change for brokers and exchanges, but all in all, a higher ticket size is generally a good way to reduce. This has been done in Korea also before. So the volumes could not drop a lot because we've just increased by, say, from 5 to 10 lakhs to 15 lakhs. So overall, it's a good thing so that retail traders start shifting more towards direct equities. Derivatives is not for any low-ticket retail trader.
Right. Thank you so much, gentlemen, for joining at this hour. So the message from SEBI is clear. It is not the first day that these norms are announced and it will be implemented tomorrow. There's a clear-cut glide path which has been given by SEBI. While the contract size for index derivatives will be increased after 20th November, similarly, rationalization of weekly index derivatives, increase in the risk coverage on day of options expiry will be done from November itself. From next year, the upfront collection of margins and also removal of calendar benefits will be implemented in February 2025. So all in all, SEBI wants to curb the frenzy which was there in F&O market. 93% of investors were making losses, and now action has been taken by SEBI. Over to you, Sumita.
Definitely, Ankur, that action has been taken. It was long impending, but of course, experts also saying that trading on exchanges, that trading volume will be impacted. But with the trade volume coming down, volatility will also drop down, given that many were actually trading with a more speculative mindset. Now that speculative mindset will slowly fade away. So that's all as far as our special coverage of SEBI's new norms is concerned.
If you like this video, then like, share and subscribe to ET Now.